Howdy, lieutenants and economists.
The most volatile, evil, disgusting things on the planet, humans. If you have a video request, you can always go to assholeconsulting.com.
Yeah, I am gonna charge you, kids. And that is the importance of not fucking up.
You are such an asshole!
Hey everybody, old Cappy here. We're coming up on Christmas. I don't even know why I get excited about Christmas anymore, because I buy all the shit that I've ever wanted. Plus, I'm a minimalist. Remember when you were a kid, you had hope, and your parents got you fucking clothes? Well, I know, do kids get everything they want nowadays? I doubt it. Hello, Cappy. I have a video request for you today. I'm familiar with your thoughts on the U.S. being overvalued in terms of its Schiller price-to-earnings ratio measured over the past few decades. Do you think it is possible to make wise investments in the U.S. stock market by investing in undervalued companies, especially ones with low PE and EV to EBITDA ratios? Also, what do you think about investing in countries with lower Schiller PE ratios like Brazil, Ireland, Russia, among others? Should one try to invest in those countries by picking individual stocks from those countries, like U.S.-listed American depository receipts, basically foreign stocks listed on U.S. exchanges? Or should one buy an index ETF such as iShares, Morgan Stanley Capital International Country ETFs? Please let me know the cost of the video. I'll gladly play. Best regards, Yodel. I believe Yodel is from Deutschland. Anyway, and I gave him the option, like, look, I could go ahead and do all the research on Brazil, Russia, and all that other crap, but it's going to take a lot more money. I could just give you the general philosophy. He says, I'll just take the general philosophy. So we're going to do the quick and dirty. The research, let's talk about the research. Oh, actually, let's explain what a PE ratio is so we don't lose everybody here. A PE ratio is the price per share of a stock divided by the earnings per share of a stock. And what that means is it allows you to gauge whether or not a stock is worth it or not. Because I don't care how many fucking billions of articles and words are written about the stock market and look at this and they're deleveraging and they're merging and all this other crap. The only reason you go into business is to make more money than you spend. And we call that profit. Because if there was no profit, there'd be no companies. Because people say, well, if I'm not going to make money, I'd be losing money. Why would I do that? It's a very simple concept that leftists have no clue, and they don't understand that without profit, there'd be no businesses. Because you wouldn't pay to lose money. So profit is the number one thing. And so when you look at a stock, you know, stocks can be penny stocks, 5 cents a share, or they can be, as in the case of Berkshire Hathaway, what are they up to? $200,000 a share because he's never let the stock split. So the price is really irrelevant because it has nothing to do with what do you pay versus what you're going to get. So what they come in with is the PE ratio. What do you pay for per share of a stock? And what is the earnings of that stock for the past 4 quarters or 12 months, okay? So this allows you to compare and allows for pricing. Like when I spend, if I look at the price of a Big Mac and it's $8, I'm like, whoa, wait. I'm paying the price of $8 for what I earn a Big Mac. Well, that's not worth it. I know Big Macs are, $2.50 beforehand or $3, I don't know. But we're all used to this intuitively. It's just that when it comes to stock prices, we need to do the PE ratio. Now, the average stock in the United States has historically traded around a PE of 15. So you pay $15 in stock price to be entitled to $1 in earnings. Now, it has gone up and down, and it depends. Sometimes it's been very high. It was like, what was it, the 60s? At the height of the was it .com? Yeah, I think it was the .com days. It was as low as, I think, 4 back after the Great Depression. So it runs the gamut, but on average, it's 15. Now, what's happened as of recent, since 1978, we've had retirement programs which basically pay people to invest in the stock market as a retirement plan. So your 401ks, IRAs, not to mention pensions, 457s, thrift saving program, all these other things. For whatever reason, we decided that we're just going to use stocks as our default retirement vehicle. So that has flooded the market with trillions over the years, and it has nothing to do with the underlying earnings or profit of the company. More recently than that, however, there's also been the quantitative easing and low interest rate policy of the Federal Reserve. This has resulted in money effectively finding its way into the stock market, either directly or through low interest rates, where banks are, say, well, we'll borrow at the Fed for nothing, and we'll lend out to corporations or high-quality corporate clients for 2%. And the corporations say, oh, look, I can borrow at 2%. I got to pay a dividend of what? So let's pay down let's buy back all of our shares. So a lot of corporate buybacks have gone in, and I have to look up the data, but I think we've surpassed the $1 trillion mark. So all this money is flooding into the stock market and has nothing to do with the underlying fundamentals of the company. It has nothing to do with the earnings that the companies generate. So what has happened is the PE ratio has gone up, and there are different measures, but the one the client is referring to is Robert Shiller. You can look him up. Great economist. One of the few that predicted the housing bubble and all that other good stuff. But he has a great database that measures the PE ratio, going back to 1871 of the S&P 500. And that's my authoritative source that I go to when I want to see whether or not the stock market's overvalued. So again, I'd have to look more recently. He does it on a monthly basis. But I think the PE ratio is 26, maybe 25. And with a historical average of 15, that means the valuation, it's overvalued by damn well near half or 60%. So, that is a concern, because as someone who is looking to maybe start saving for retirement, or if you're looking to save for retirement, why would you pay an extra 60% for something that historically has traded at a PE of 15? Why do I get to pay 26 when it's historically been 15? Now, of course, most people are idiots. They're fucking morons. They just automatically hit auto invest on their 401ks and IRAs, and they give no shits. Absolutely zero fucks are given when people invest in their 401ks or IRAs. Now, what this young man is talking about is like, okay, well, look, all this money has been flooding into the U.S. markets. What about foreign markets, or what about looking for low PE ratios for stocks as potential investments? And the short answer is yes. Now, the reason I say that is Robert Shiller, same economist, has a study on the exact same page where he did a study looking at the average annual returns of stocks based on PE ratios. And what he found is that the lower the PE ratio, the historically, though not guaranteed, the higher the rates of return. And what the debate was simply this, is like, do lower priced stocks provide higher rates of return? Now, you may say, well, duh, of course they do, so let's all go with low PE ratios, but you have to understand there's one aspect or thing with the PE ratios. The price to earnings is the current price divided by the historical earnings. All right, and there's a problem here. You don't buy a stock and then you get historical earnings. You buy a stock and then you're entitled to the future earnings, of which we don't know what that is. So what the PE ratio really becomes is not so much, it is a value, it is a measure of value. It is a measure of like, okay, is this amount of earnings worth this price? So it is, but that is looking in the past, which really is not what you're going to earn in the future. That's the future, that's what you're going to earn. So it is more of a representation of people's expectations in the future of that company. For example, the historical average is 15. But back in the dot-com mania days, you know what Yahoo was trading at? 471. People were paying $471 in stock price to be entitled to $1 of historical earnings of Yahoo. And you say, well, who would pay 471? Because if you think about it mathematically, well, if that company keeps earning that same amount of money every year, it's going to take you 471 years to break even. Well, the thing is, people weren't expecting Yahoo to make just that same dollar in earnings. This was in the height of the dot-com mania days. The internet was blowing up. People were looking at the future, and they're saying, it may not be earning a lot of money now, but down the road, that thing's going to go gangbusters, and the earnings are going to grow exponentially. So in this case, high PE ratios can be warranted. They can be legitimate, especially if you're looking at a company that's on the verge of growth. But they also are more of a reflection of people's expectations of future earnings. So high PE ratios say, we think this is going to be a high growth stock, and low PE ratios are like, well, we don't think it's a high growth stock. Matter of fact, we think it might lose money in the future, so why would I pay a high price for this historical amount of earnings when the earnings are going to go down in the future? But still, the study that Robert Shiller did, it's a beautiful chart. He plots a nice histogram. Or scattergram, sorry. And even, in other words, people are overly optimistic about the future earnings growth of companies. And so when you account for that and they're overly optimistic, that means the low PEs, on average, no guarantee though, on average, tend to be the better investment. So yes, that is the concept there. Now here's the problem though. Good luck finding historical data on Brazil, Ireland, and Russia. I know maybe not the OECD, maybe Bloomberg terminals might have this data. I mean, I remember no more than 20 years ago, you couldn't find the PE ratio of the S&P 500. It was a pain in the ass to calculate. Well, now, with about 20 years of the internet, we're finally getting some historical data. And also, economists, researchers like Robert Schill have gone back and recalculated things going back to 1871. But that doesn't mean that our second and third world counterparts have been as meticulous in recording PE ratios and have the financial data. So we don't know if Brazil has a PE ratio of 15. We don't know if Russia's average PE ratio is 15. It could be something completely different. So you wouldn't use that same standard measurement or that same rule of thumb on foreign countries. You'd have to go back and track. You'd preferably like something a little bit more longitudinal, because you don't want to just take the past 10 years, because that includes the financial crisis. Then that throws things off. But in general, if you could find lower priced stocks based on PE overseas, so far the research as it seems that's the way to go. Okay. Now, of course, it's obviously other risks involved with going overseas. There's interest rate exchange risk. There's political risk, like Brazil just says, we're going to take it over. I mean, heck, we don't even have to be foreign risk. Look at what fucking Puerto Rico did to Walmart. They just said, well, we're going to take 92% of your earnings. Come invest in Puerto Rico. I mean, it was just to bail out single moms. And I know that sounds insulting, but the truth of it is, look at it. It was to bail out single moms. It's hilarious. So you'd be like, well, why would I invest in Brazil or Russia? Shit, you gotta bribe the local mafia don just to get your fucking dick in the door. Ireland, that'd be a little bit less. So this is where you start doing sovereign risk analysis. This is where you look up the transparency index or the corruptions index. You read the Economist Intelligence Unit. There's all this. I used to do this back when I was like 21, back in the day. But anyway, so you'd have to do a full-fledged foreign analysis before you start getting involved in these countries. But in general, yes, you can invest in ETFs overseas. You can diversify, look at low PE ratios, look at high dividend yields, which is kind of one and the same thing if you want to research that more. But again, there's no guarantee, absolutely none. I mean, this is because you're trying to predict the future. We can look at the past. We can look at historical price to earnings ratios. We can look at historical dividend yields, kind of the same thing again. But we don't know what the earnings or dividends of these companies are going to be. We don't know what's going to happen in the economic growth or the politics of these countries. And you can do a ton of research and kind of figure it out. But again, there are no guarantees. But yeah, I mean, it's based on Schiller's research. Yes, it seems that the low PE is the way to go. May not always hold out to be that way. But based on the data so far, yeah, low PEs are historically have provided higher rates of return. But again, no guarantees that's going to continue in the future, and no guarantees that would work in other countries. So, best of luck. Toodles.